Right now, $5.5 billion in gold export revenue is flowing into Ethiopia in a single fiscal year. That single commodity now generates roughly half of the country's entire foreign exchange earnings. And it was not a lucky geological accident. Official data shows Ethiopia generated more gold export value in this single fiscal year than it accumulated across the entire 27 years prior to 2018 combined. It started with a quiet monetary policy change in July 2024 that completely broke an underground smuggling network. It escalated when international mining companies quietly moved heavy industrial plant equipment into strategic border regions. And right now, it is creating a high-stakes economic pivot that could either anchor East Africa's next industrial leader or leave its balance sheet exposed to global market swings. Here is how Ethiopia turned its soil into a multi-billion-dollar foreign exchange engine. For decades, Ethiopia faced a structural economic leak. Hundreds of thousands of artisanal panners were pulling raw gold out of riverbeds in Oromia, Benishangul Gumuz, and Gambela. But very little of that metal reached central bank reserves. The reason was currency arbitrage. The government maintained a fixed artificial exchange rate for the Ethiopian birr. If a miner sold gold to the National Bank of Ethiopia, the NBE, they were paid in official birr, missing out on real-world street values. If they sold to illicit cross-border buyers, they received hard cash or parallel market rates. In July 2024, the government floated the birr and unified the exchange rates. Overnight, illicit traders lost their price advantage. The central bank offered competitive, market-aligned rates with official purchasing bonuses. Artisanal miners routed their production through legal banking channels, driving official gold export earnings up by 62% year over year. At the same time, institutional monetary reforms backed by international financial institutions began reshaping the NBE's structural role. For years, buying domestic gold required substantial local currency issuance, which created unwanted inflationary pressures across the domestic market. Transitioning the central bank from a direct market monopsony into an independent regulatory authority allows commercial financial institutions and private traders to handle gold transactions. This shifts gold from an inflationary reserve tool into a formal commercial export market. But artisanal mining alone could never sustain a multi-billion-dollar export boom. That required something entirely different: industrial-scale gold production. Geologically, Ethiopia sits on the southern greenstone belts of the Arabian-Nubian Shield, an ancient geological formation rich in hard rock gold deposits. The bottleneck was never the geology. It was project capital, heavy machinery, and reliable industrial power. Processing tens of thousands of tons of hard rock daily requires immense electrical output. In remote border regions like Benishangul Gumuz, industrial gold milling was historically constrained by diesel logistics and isolated energy grids. That structural bottleneck changed with the commissioning of major national power infrastructure. Located in the very same Benishangul Gumuz region where some of Ethiopia's largest gold deposits lie, the Grand Ethiopian Renaissance Dam provides over 5,000 megawatts of generation capacity. High-voltage transmission lines extending into remote greenstone districts now deliver cheap, continuous hydroelectric power directly to heavy industrial crushers, ball mills, and processing facilities. Access to clean grid power dramatically lowers operational expenditures for hard rock extraction, making multi-hundred-million-dollar mine developments commercially viable. Now, two major industrial developments are scaling up East Africa's mining footprint. First, the Kurmuk Gold Project, developed by Allied Gold in Benishangul Gumuz near the Sudanese border. Supported by direct access to regional energy corridors, this site is engineered to process tens of thousands of tons of ore daily, targeting nearly 290,000 ounces of gold annually in its primary operating phase. Second, the Tulu Kapi project in western Oromia, led by KEFI Gold and Copper. Supported by over $400 million in project financing, Tulu Kapi is designed to add another 200,000 ounces per year. Together, these industrial assets are transitioning Ethiopia into a primary hard rock producer. But building capital-intensive processing operations in remote border corridors carries significant operational logistics. Global investors face a core strategic question. How do you protect a multi-billion-dollar industrial supply chain in a dynamic regional environment? Resource extraction in East Africa is deeply tied to regional dynamics. The greenstone belts holding Ethiopia's primary deposits run through zones that require continuous alignment between local communities, regional administrations, and federal security frameworks. For foreign mining companies, the equation balances operational complexity against high geological yield. Simultaneously, international environmental, social, and governance (ESG) standards have become essential. Historical artisanal panning left legacy environmental footprint challenges in several river basins. For industrial operators to access international debt markets, projects like Kurmuk and Tulu Kapi must maintain strict environmental compliance, including closed-circuit tailings management, water containment, and transparent community revenue mechanisms. Beyond individual mine operators, a quiet geopolitical race is unfolding over who finances and controls Ethiopia's mineral infrastructure. To institutionalize this influx of capital, the government activated Ethiopian Investment Holdings, EIH, Africa's largest sovereign wealth fund by managed assets. Rather than simply issuing raw extraction concessions to foreign firms, EIH is taking direct equity stakes in joint venture processing plants and logistics hubs. This state-led model has attracted billions in foreign direct investment from major global players. Asian joint ventures are committing capital to build dedicated mineral special economic zones and domestic processing plants. At the same time, Gulf capital and global trading houses are competing to finance infrastructure corridors, securing long-term offtake agreements for refined bullion. By leveraging sovereign equity, Ethiopia is attempting to ensure that value addition remains inside national borders rather than leaving as unrefined raw ore. While gold is providing the immediate foreign exchange windfall, the regulatory and energy blueprint built around gold is expanding across Ethiopia's broader mineral reserves. Massive potash deposits in the Danakil Depression, along with lithium and tantalum reserves in western and southern districts, are now being mobilized under new joint ventures. The long-term strategy is clear. Use gold revenues to build power lines, transport hubs, and domestic refineries, converting underground wealth into a multi-commodity industrial base. The $5.5 billion gold surge provided Ethiopia with an immediate foreign exchange buffer during a critical period of macroeconomic restructuring. It supported essential imports, expanded central bank foreign reserves, and strengthened international credit standing. Yet macroeconomists highlight a key structural challenge: export concentration. Gold and coffee combined currently account for nearly 78% of Ethiopia's total merchandise export revenues. When global commodity spot prices are elevated, state reserves expand. But heavy reliance on raw commodity exports leaves national earnings vulnerable to international market fluctuations. Gold may have opened the door. Whether Ethiopia becomes a broader industrial powerhouse or remains a resource-dependent economy depends on what happens next. And gold is not the only strategic asset altering leverage across the Horn. To see how regional competition over maritime trade routes and commercial ports is shaping the economic landscape right across the border, click the video on your screen right now.